It's banking which has been the spoilsport today. The whole list of banks, IDBI Bank, Bank of India, Axis Bank, Kotak Mahindra Bank, Allahabad Bank, PNB, SBI, they're all in the red. That's the reason the stock market has not been able to build on its morning gains. Of course, one of the reasons has been that bond yields have hardened quite considerably because of the government's huge borrowing program over the last few days. So what was sub 5% is now 7%, though it has come off the highs of the last couple of days. How much of a worry does this represent, this stickiness in interest rates? Rajiv Anand of Axis Asset Management Company and Hemant Mishr of StanChart join in to debate that. Gentlemen, morning. Thanks for joining in. Hemant, is 7% it, or do you think bond yields will remain stubbornly at 7% plus even over the next one quarter?
Would then be expecting the bond yields to settle in a range of 675, 725. A lot depends on what the RBI does now, because the first half borrowing calendar is out, so there is no suspense around that. So you know what exactly the auction amount for the first half is. In fact, you know the weekly numbers. Also know the amount that they're going to be buying back. A lot depends now on monetary policy. What is it that they do? If they go ahead and cut aggressively, which is very likely pre-elections, you might see the near end come off, but the long end, unfortunately, is likely to continue sticky at around 7%.
Rajiv, what impact will it have, you think, on real lending rates? Because bankers have been resisting. I mean, they have made some changes or some lowered the interest rates by small amounts, but there seems to be a resistance in lowering rates significantly from these levels. Given where bond deals are, do you think it will be true that despite RBI's lowering of rates, real lending rates or even deposit rates may not come off significantly over the next 1 or 2 quarters?
Absolutely. I think that's really the problem. If you look at it historically, in an environment or such a benign interest rate environment, typically the spread between the 10-year bond and the 1-year bond hovers around somewhere below the 100 basis points level. Today it's in the vicinity of 200 basis points, like you rightly said, because of the huge government borrowing program. If you look at corporate bond spreads as well, I mean, they have not pulled as significantly as they did in the previous the bond bull market in, let's say, between 2001 and 2003. Today, a 5-year corporate still continues to trade some, and this is a AAA corporate, PSU corporate, would trade somewhere in the vicinity of about 200 basis points. So I think although the long end of the yield curve will continue to have its problems from the government borrowing program, I think there is still fair amount of scope for interest rates in general in the economy to come down, and I think it will happen. I think there is some of the old deposits which banks put on at fairly high cost, those will begin to fall off. But I think going forward, I think we should see housing rates, auto loan rates, or PLRs for that matter. I think they should come down in the next, let's say, 3 to 6 months.
Hemant, while you indicated that the longer term might stay around that 7% mark, in the near term, how much of a cool off are you expecting? Because this run past 7% has come quite fast.
Yeah, I agree with you. Unfortunately, not too much, because whichever yardstick you use, the outlook is not very positive. From a fundamentals perspective, and the fiscal numbers continue not to look particularly good, tax collections have not been very rosy. From a positioning perspective, the banking sector is significantly above its statutory requirements, so which means that incremental demand would be limited. But in my opinion, the spoil sport is sentiment. Sentiment is pretty negative at this point in time, and the market would actually ignore the positives, even if some positives were to flow in. The inflation number has been a positive number, fairly well discounted into the market. Having said that, the market's got no appetite to be focusing on positives. So not too much below 7, 675, 7 in the absence of no monetary action from the Reserve Bank of India. If they're pleasantly surprised, then you settle to a lower range, but not significantly lower than where we are at this point in time.
Rajiv, aside from action on the monetary front, do you expect appetite amongst the banks to remain as robust for bonds generally?
Yeah, I think that's really the slightly scary part at this point in time. If you look at the numbers over the last couple of weeks, we've actually seen a fairly strong pickup in credit as opposed to, let's say, 3 or 4 quarters before that. And two, and more importantly, banks by and large have been net sellers of government securities. So therefore, I'm not for a moment saying that at least that's the anecdotal evidence today. But I'm not sure whether that's a trend. But if that is a trend, then you're actually seeing the classic sort of crowding out impact, where the banks do have some sort of credit growth going for them, and in which case the whole play of the fact that the excess money will really go into government securities may not necessarily play out, in which case you could have a bit of a problem as far as the government borrowing program itself is concerned.
Hemant, you track the rupee as well. Do you think now that the dollar has snapped its winning run, though it has come back again in the last 2 or 3 sessions, can the rupee come back and settle below 50, or do you think it will still hold that sticky 50 to 52 kind of range in the foreseeable future?
I see it settling below 50, which is what I did mention in the same show some time ago. Then near term, I think the rupee would continue to be weaker, so I wouldn't be surprised if you again see a test of 52. Having said that, towards the end of next quarter, levels around 48, 49 are very likely. Two important drivers. One is how the dollar behaves internationally. And given the Geithner plan means a lot more dollars in the system, from a demand-supply perspective, the value of the dollar internationally needs to be coming down. The same should be replicated onshore. And B is our own balance of payment numbers. Our estimates they will contract significantly compared to the numbers that we've seen in the earlier quarter. So both these would be positive, but that would take some time to play out, because at this point in time, the markets are focusing on risk aversion. And most Asian countries, and as an extension, currencies are getting a bit weaker on account of this.
Thanks, gentlemen, for joining in with your thoughts on the money market. That's where